If we have to borrow money, we borrow. It's not borrowing is not a leprosy. We just have to work hard to be able to pay for it.
On June 9, 2026, the IMF told Nigeria's government directly, "This $5 billion loan structure is opaque, it carries serious risk, and you should consider issuing Eurobonds instead." 10 days later, Fitch Ratings, a completely independent credit agency, issued its own warning using almost the same language. Nigeria's government did neither. In the days that followed both warnings, Nigeria drew down the first $1.5 billion tranche of the loan anyway. While everyone is debating whether Tinubu should have taken this loan at all, nobody is asking the more specific question. Why would a government proceed with a financing structure that two separate, independent institutions flagged as carrying the exact kind of risk that caused repayment crises in Senegal and Angola, countries Nigeria's own loan documentation cites as comparison cases? Because the answer is not about economics, it's about timing. And once you see the calendar, you'll understand exactly why this loan had to happen now, regardless of what the IMF said. If you're new here, this channel exists for one reason: to give Nigerians the political analysis mainstream media won't. Hit subscribe and stay with me, this gets deeper.
March 31, 2026. President Tinubu wrote to the Senate seeking approval for $6 billion in external borrowing, a $5 billion total return swap facility with First Abu Dhabi Bank of the UAE, and a separate $1 billion UK export finance facility arranged through Citibank London for Lagos Port Complex and Tinkan Island port rehabilitation. The Senate approved both requests the same day, within roughly 4 hours of receiving the formal request. April 25, 2026. Tinubu sought a further $516 million loan for the Sokoto-Badagry Superhighway, bringing total recent external loan commitments towards $7.8 billion when combined with a $1.25 billion World Bank facility under consideration and a $516 million Deutsche Bank arrangement. June 9, 2026, the IMF's resident representative for Nigeria, Christian Ebeke, presented the fund's 2026 Article 4 consultation report and explicitly warned against the TRS structure, describing it as opaque, carrying risk, and recommended Eurobonds or concessional financing as transparent alternatives. June 19, 2026, Fitch Ratings published Emerging Market Sovereigns' Use of Total Return Swaps Raises Risks, independently flagging Nigeria's deal as a case study in how TRS structures can create hidden liabilities. Late June 2026, Bloomberg reported, citing people familiar with the transaction, that Nigeria had drawn approximately $1.5 billion as the first tranche of the facility, proceeding with the deal despite both the IMF and Fitch warnings. Tinubu has described the funds as financing for the 2026 budget, priority infrastructure, chiefly the 700-kilometer Lagos-Calabar coastal highway connecting the southwest to the south-south, port rehabilitation, energy infrastructure upgrades, and refinancing of existing expensive domestic and external debt. He has publicly characterized the UAE deal as a major achievement. This story has moved from a policy debate into an active financial event. For 3 months, the conversation was hypothetical. Would Nigeria proceed despite IMF concerns? The June drawdown answers that question definitively. The story is no longer, will Tinubu ignore the warning? It is, Tinubu ignored the warning, and the first $1.5 billion is already out the door. That shift from hypothetical to actual is what makes this the moment for a comprehensive breakdown.
Institutions involved: the Presidency and Federal Ministry of Finance, which negotiated and structured the TRS deal; the National Assembly, Senate and House, which approved the borrowing request in a same-day vote; First Abu Dhabi Bank, UAE, the counterparty providing the $5 billion facility; the IMF, which conducts the annual Article 4 consultation, a routine but influential health check on member economies; Fitch Ratings, an independent credit rating agency whose assessments affect Nigeria's borrowing costs on international markets; the Debt Management Office, DMO, which manages and reports Nigeria's public debt profile; the Central Bank of Nigeria, CBN, relevant to the dollar margining obligations tied to the facility. A total return swap is fundamentally different from a conventional sovereign loan. In a standard Eurobond, Nigeria borrows a fixed amount and repays principal plus a fixed or predictable interest rate over a set schedule. In a TRS, Nigeria pledges an underlying reference asset, in this case reportedly tied to instruments linked to Nigeria's crude oil performance and Naira-denominated federal government securities, and the UAE bank is entitled to receive the total return on that asset, every interest payment plus any capital appreciation, calculated at each repayment point. This means Nigeria's repayment obligation is not fixed in the way conventional debt is. If oil prices fall, or if the Naira depreciates further during the life of the facility, the value Nigeria owes can increase even though the original principal amount did not change. The Senate's approval for the issuance of Naira-denominated federal government securities as collateral, along with the requirement to pay margining obligations in US dollars, compounds this exposure. Nigeria must post additional dollar collateral if the value of the pledged assets declines, exactly the kind of margin call risk that hit Senegal and Angola when commodity prices moved against them. Nigeria's Fiscal Responsibility Act and the Debt Management Office's enabling legislation require National Assembly approval for external borrowing above certain thresholds, which is why this loan went through a Senate vote. But the speed of that approval, same day, within roughly 4 hours of the formal request being read, raises a structural question about how much genuine scrutiny is built into the process. The Senate Committee on Local and Foreign Debts, chaired by an APC senator, presented its report and recommendation within the same session in which the request was received. The IMF has no formal veto power over Nigeria's sovereign borrowing decisions. Article 4 consultations are advisory. Nigeria is not violating any IMF program conditionality by proceeding with the TRS because Nigeria is not currently under an active IMF lending program that would impose such conditions. This is the critical institutional ambiguity. The IMF can warn, but it cannot compel. Nigeria's sovereign right to determine its own financing structure is real and legally unconstrained by the IMF's Article 4 recommendations. The precise terms of the TRS, the specific underlying reference assets, the margining trigger thresholds, the total cost of capital compared to a conventional Eurobond have not been fully disclosed publicly. This is exactly the opacity the IMF and Fitch flagged. The structure makes it difficult for the National Assembly, civil society, and ordinary Nigerians to independently assess whether this is a good deal or a dangerous one, because the full terms are not in the public domain in the way a standard Eurobond prospectus would be.
In the immediate term, the Tinubu administration benefits from rapid access to dollar liquidity without the longer issuance process, investor roadshows, and market timing risk associated with a Eurobond. TRS facilities can typically be drawn down faster than bond issuances, which matters if the government has near-term budget execution pressure, funding the 2026 budget, meeting debt servicing obligations projected at 15.81 trillion naira for 2026, and maintaining the visible momentum of flagship infrastructure projects like the Lagos-Calabar Coastal Highway ahead of the 2027 election cycle. First Abu Dhabi Bank and the UAE benefit from a profitable, well-structured financing relationship with Africa's largest economy, deepening Gulf state financial influence in West Africa at a time when Gulf sovereign wealth funds and banks are actively expanding their African lending books as an alternative to traditional Western development finance. Nigeria's fiscal credibility with traditional multilateral partners, the IMF and World Bank, is the primary casualty if the TRS structure performs poorly. Proceeding against explicit IMF advice, even without violating any formal program, sends a signal about how seriously Nigeria treats fund recommendations, which matters for future Article 4 engagement tone, and for how the IMF characterizes Nigeria in its public communications that other investors and rating agencies read closely. The Debt Management Office's public credibility on debt transparency is also at stake. Nigeria has worked since 2023 to rebuild investor confidence through more transparent reform communication. An opaque financing structure cuts against that narrative at the exact moment the IMF's own report credited Nigeria with improved policy credibility and regained market access. The government's stated purpose, infrastructure financing, and Obi's claim that the money is substantially servicing existing debt are not mutually exclusive, and the numbers show why. Tinubu's own March 2026 letter to the Senate stated the funds would support budget execution, priority infrastructure development, and the repayment of costly domestic and foreign debts, all three in his own words. The 2026 budget's projected 15.81 trillion naira debt servicing obligation is a real simultaneous claim on government cash, alongside the infrastructure commitments. Both Obi and the presidency are describing different slices of the same pool of borrowed money. The Lagos-Calabar Coastal Highway is not a politically neutral infrastructure project. It connects Tinubu's home political base in the southwest to the south-south, a swing region in national elections. Visible, fundable progress on that highway ahead of the 2027 campaign is a tangible electoral asset, arguably a more politically valuable use of borrowed dollars than abstract debt refinancing, even if both appear in the same financing package. The timing pressure to access dollar liquidity quickly, rather than wait for a more transparent but slower Eurobond process, aligns closely with the practical need to show infrastructure progress before the 2027 campaign season begins in earnest. The southwest and south-south stand to see the most visible infrastructure benefit from the coastal highway specifically. The north, by contrast, sees less direct benefit from this particular financing package, beyond the broader fiscal stabilization argument, which raises regional equity questions that opposition figures from northern states, including Atiku, have previously highlighted in their criticism of federal borrowing patterns. Silent stakeholders include Nigerian pension funds and domestic bondholders, whose returns and the government's domestic borrowing costs are indirectly affected by how international rating agencies like Fitch assess Nigeria's overall debt sustainability following this TRS drawdown. A downgrade or negative outlook change driven partly by TRS-related risk would raise borrowing costs across Nigeria's entire debt profile, not just this specific facility. Now, if what I just told you surprises you, drop a comment below. I want to know what you think before we get to the part that changes everything.
Nigeria's total public debt stood at approximately $110 billion, 159.2 trillion naira, as of December 31, 2025. Projected 2026 debt servicing obligations of 15.81 trillion naira represent a substantial claim on federal revenue that directly competes with spending on health, education, and poverty alleviation, sectors whose combined 2026 budget allocation, according to Obi's own published analysis, totals approximately 5.885 trillion naira, meaning debt servicing alone is projected to cost nearly 3 times what the government allocates to health, education, and poverty alleviation combined. The IMF's own Article 4 report, the same document containing the TRS warning, states that Nigeria's poverty rate is 63%, with millions facing food insecurity, and explicitly notes that the benefits of the 2023 reforms have not yet reached most households. This creates the central economic tension of the entire story. Nigeria has rebuilt macroeconomic buffers, CBN gross reserves at $50 billion, the highest in 17 years, according to the central bank, while underlying household poverty remains severe, and now compounding debt servicing costs limit the fiscal space available to address that poverty directly. Infrastructure financing decisions like the Coastal Highway have downstream federal-state balance implications. States along the highway corridor receive direct project investment and associated economic activity, while states outside the corridor see comparatively less direct benefit from this specific financing package, even as all states share in the national debt servicing burden through reduced federal allocations available for other transfers. This regional distribution question compounds the existing zoning and equity debates active in Nigerian federal politics during 2026.
The IMF's Article 4 consultation represents the most authoritative Western multilateral institutional position available on this specific transaction, and it is unambiguously cautionary. Fitch Ratings' independent warning, issued by a private credit rating agency with direct commercial stakes in accurately pricing Nigerian sovereign risk for global investors, reinforces rather than merely echoes the IMF's concern, which strengthens the credibility of the warning considerably. Two institutions with different mandates and different incentive structures reached substantially the same conclusion independently. Neither the US State Department nor the UK Foreign Office has issued a public statement specifically on the TRS deal as of this production date. This is consistent with normal diplomatic practice. Bilateral sovereign financing decisions between Nigeria and the AUA are not typically the subject of third-country government commentary unless they raise specific sanctions, money laundering, or strategic competition concerns, none of which have been publicly alleged here. Nigeria's TRS deal is part of a broader, well-documented pattern, African and emerging market sovereigns increasingly turning to Gulf-based banks and sovereign wealth vehicles for financing as an alternative to or supplement of traditional Western development finance institutions and Eurobond markets. Senegal and Angola, both cited in IMF and Fitch reporting as comparison cases, took similar derivative-backed financing routes and experienced repayment stress when commodity prices moved against them. This is a global pattern of resource-rich, fiscally constrained governments accessing faster but less transparent capital, and it reflects a broader geopolitical shift in where developing economy sovereign financing is sourced from. For Nigerians in the UK and US, the relevance is direct. A sovereign debt structure that increases Nigeria's vulnerability to a sudden funding crisis raises the same kind of risk that has historically preceded currency crises, IMF bailout programs with strict conditionality, and periods of acute economic hardship that drive immigration pressure and reduce the value of remittances sent home. Diaspora households who support family members in Nigeria have a direct financial stake in whether this TRS structure performs as the government expects or produces the kind of repayment stress the IMF specifically warned about.
The most intellectually honest case for proceeding with the TRS despite IMF concerns rests on 3 points. First, Nigeria has a sovereign right to choose its financing structure, and the IMF's warning is advisory, not binding. Treating every IMF caution as an instruction Nigeria must obey would cede an inappropriate degree of policy sovereignty to an institution that does not bear the political or fiscal consequences of Nigeria's choices. Second, TRS structures, while riskier than conventional bonds, can offer genuinely faster access to capital at competitive pricing when a government has urgent, time-sensitive infrastructure or budget execution needs, and Nigeria's infrastructure deficit is severe enough that delay itself carries real economic cost. Third, the IMF's own Article 4 report simultaneously praised Nigeria's broader reform trajectory, the subsidy removal, monetary tightening, and exchange rate liberalization, crediting these measures with rebuilding reserves to a 17-year high and regaining international capital market access. A government with genuinely improving fundamentals has a more defensible case for taking calculated risk on a faster financing structure than one without those fundamentals. Misconceptions in public discourse. 1. The IMF banned this loan. The IMF has no authority to ban or block Nigeria's bilateral sovereign borrowing. Its Article 4 consultation is an advisory health check, not binding conditionality, because Nigeria is not currently under an active IMF lending program. 2. This is the same as a normal Eurobond, just from a different country. It is structurally distinct. A Eurobond carries fixed, transparent, publicly disclosed terms. A total return swap ties repayment to asset performance and currency movement, with terms that have not been fully publicly disclosed. That distinction is the entire basis of both the IMF and Fitch warnings. 3. Obi's debt figures and the presidency's explanation can't both be partially right. They can be and largely are. Currency devaluation, inherited debt, and substantial new borrowing are all simultaneously true contributors to Nigeria's current debt profile. Treating this as a binary who is lying question obscures a more complete and more useful picture. Nigeria's core national interest in this specific decision is not whether borrowing happened. Emerging economies routinely and legitimately borrow to finance infrastructure and budget gaps. The national interest is in whether the structure chosen genuinely served Nigeria's negotiating position, or whether speed and political timing pressure led to accepting materially worse terms than a more transparent, slightly slower alternative would have provided. The IMF explicitly suggested Eurobonds as a viable, more transparent alternative, which means the trade-off was a real choice, not a forced necessity. For the Southwest specifically, the region most directly being from the coastal highways anchor investment, the strategic interest is in ensuring that the visible regional infrastructure gain does not obscure the national fiscal exposure being taken on to fund it. A highway built on opaque, potentially unstable financing terms is a regional asset with a national liability attached, and Southwest political and business leaders who will publicly champion this project's completion have a responsibility to also engage honestly with the financing risk that underwrites it, rather than treating regional infrastructure benefit and national fiscal prudence as separate, unconnected conversations.
The long-term significance of this episode is not the $5 billion figure itself. Nigeria's total public debt already exceeds $110 billion, making this single facility a meaningful but not singularly decisive addition. The significance is in what the decision reveals about the Tinubu administration's risk tolerance and decision-making process when speed and political timing compete against transparency and multilateral institutional advice. A government willing to proceed against two independent warnings on a specific financing structure is a government that have made a clear, demonstrated choice about how it weighs those competing considerations. And that choice will likely recur in future financing decisions as the 2027 election approaches and infrastructure delivery pressure intensifies. If the TRS performs without triggering the margin call and hidden liability risks the IMF and Fitch warned about, this episode becomes a footnote, a calculated risk that paid off. If oil prices or the Naira move unfavorably during the facility's life, this episode becomes the case study cited in the next IMF Article 4 report as the moment Nigeria was warned and proceeded anyway. We opened with a question. Why would a government proceed with a financing structure that two independent institutions flagged as carrying the exact risk that caused crises elsewhere? The answer, as we've mapped it, is timing. The political timing of infrastructure delivery ahead of 2027 and the fiscal timing of urgent budget execution needs that the devaluation-only explanation cannot fully account for. That answer does not make the decision wrong. Nigeria has the sovereign right to choose speed over maximum transparency when its calculation of national interest points that way. But it does mean Nigerians, and the political figures who claim to represent their interests from the presidency to Obi to Atiku, owe the public a more complete accounting than has been offered so far. Not a debate about whether borrowing happened, a debate about whether this specific structure, on these specific terms, with these specific risks the IMF and Fitch both identified, was the right call. That debate has not actually happened yet. What has happened is a warning, a drawdown, and a political argument about debt totals that talks past the central question. Until Nigeria has that more complete conversation, the $1.5 billion already drawn and the $3.5 billion still to come remains a calculated risk whose outcome nobody can yet confirm. Drop your analysis in the comments. Do you think the government made the right call proceeding despite the warnings? Or is this the kind of decision that looks fine until the moment it doesn't? And what should Nigeria's borrowing strategy prioritize heading into 2027? Speed or transparency? If this analysis gave you clarity, share it with one person who needs to understand what's really happening. Like, subscribe, and I'll see you in the next one.